If you think buying an S&P 500 index fund means you are instantly diversified across 500 perfectly balanced companies, you are mathematically wrong. In fact, if just 7 companies drive almost a third of your entire portfolio's performance, you are not actually diversified at all. You are placing a massive, highly concentrated macroeconomic bet on a single sector. I see this exact scenario play out every single day. People take their hard-earned life savings, dump it into a standard market cap-weighted fund, set the entire thing on autopilot, and blindly assume they have completely eliminated idiosyncratic risk. But they haven't done that at all. What they have actually done is dress up a high-beta momentum trading strategy in a safe, boring, societally approved wrapper. We need to strip away the marketing. Let us walk through the brutal, objective numbers of what you actually own when you hit buy on the S&P 500 today, and why treating it as a flawless, perfectly diversified safe haven is a hidden trap that could severely punish your net worth over the next decade. We are going to break down the brutal math of index concentration, the underlying psychological game theory keeping everyone trapped in it, and the specific 4-step optimization protocol I personally use to hedge against this exact vulnerability. But first, if you find this kind of calm, deep dive financial analysis helpful, the best return on investment for your time today is to hit that subscribe button. It directly helps me keep these videos rigorous, data-driven, and completely free from the usual screaming internet finance fluff. Now, let us look at the most pervasive piece of financial advice of the 21st century. Just buy the S&P 500, dollar cost average into it, and chill. It is the ultimate diversified portfolio, right? Well, Jack Bogle was absolutely correct when he identified that active management fees destroy wealth over time. Society rightfully adopted his low-cost index philosophy. But somewhere along the way, the average investor completely conflated the investment vehicle, which is the low-cost index fund, with the underlying index construction methodology, which is market cap weighting. Over the last 15 years, the S&P 500 has absolutely crushed almost every other asset class on Earth. It has been a phenomenal, historic run. Because of that sustained outperformance, the average retail investor now firmly believes this is a permanent law of financial physics, rather than a historically specific cycle. I have run those numbers, and it is crucial to recognize that this massive run-up was largely driven by a very specific cocktail. We had a decade of zero interest rate policy, combined with the massive, one-time digitalization of the entire global economy. When you look closely at the macroeconomic data, you start to see severe survivorship bias and American exceptionalism coloring our collective judgment. We assume the largest United States companies will always dominate simply because they have dominated our recent memory. But market cycles are notoriously ruthless. By blindly trusting the recent past, we conveniently ignore the underlying mechanical reality of how these cap-weighted funds actually distribute your money today. The human brain naturally looks at a number like 500 and assumes it equates to safety through sheer volume. Most retail investors simply do not understand the underlying mechanics of market capitalization weighting. They assume a $10,000 investment puts roughly $20 into 500 different, distinct American businesses. That is the illusion of quantity, and it is an incredibly dangerous mental model. You are not buying 500 equal slices of the economy. Because the index weights holdings by their sheer market size, your money is aggressively funneled toward the absolute largest corporations at the very top. The smallest companies at the bottom of that list receive pennies on your dollar, rendering their presence in your portfolio almost mathematically meaningless. To put this structural flaw into perspective, imagine a massive cargo ship carrying exactly 500 shipping containers across the ocean. You are standing on the dock, and the ship's captain assures you the vessel is perfectly balanced because it has exactly 500 individual containers on board. But what he casually fails to mention is that 7 of those specific containers are filled to the absolute brim with solid lead, while the remaining 493 containers are filled with light feathers. If a sudden leak occurs in the specific section holding the lead, that entire ship is going straight to the bottom of the ocean. The sheer quantity of total containers is entirely irrelevant if the actual weight distribution is drastically skewed. Most people stop right here, and that is a massive mistake. They hear that the S&P 500 is a bit top-heavy. They shrug their shoulders and they say, well, those top tech companies are printing billions in free cash flow, so who really cares? That exact line of complacent thinking is where conventional wisdom quietly costs everyday investors tens of thousands of dollars over their lifetime. If you think the current concentration in mega-cap tech is just a harmless quirk of a bull market, wait until you see the absolute math on what happens during a routine cyclical market correction. In the next few minutes, I'm going to show you how a minor tech stumble can completely wipe out a year of gains in the broader market, and calculate exactly how much the bottom 493 companies have to overperform just to save your portfolio. The mathematical failure of the broader diversification narrative lies directly in how the S&P 500 is actually built. It is a market capitalization weighted index. That means, as a specific company's stock price rises, it commands a proportionately larger percentage of the entire index. By mathematical definition, buying the S&P 500 is fundamentally a trend-following momentum strategy. You are automatically forced to buy more of whatever has already gone up the most. Let us look at the concentration reality today. The top 7 companies, often referred to in the financial press as the Magnificent Seven, currently constitute roughly 30% of the index's total weight. Think about the gravity of that for a second. You have 30% of your total downside risk allocated to roughly 1.4% of the actual companies in the fund. And these 7 mega-cap companies are not economically diverse by any stretch. Their revenues are highly correlated, relying on the exact same semiconductor supply chains, digital advertising spend, artificial intelligence capital expenditures, and consumer tech hardware cycles. Managing your life savings like this is dangerously similar to coaching a basketball team where one superstar player takes 30% of the total shots. As long as he is draining his three-pointers, the team looks virtually unbeatable. You sit on the bench and feel like an absolute genius of a coach. But the moment he sprains his ankle, the entire team fundamentally collapses, because the other players simply haven't developed the offensive volume or rhythm to compensate for his sudden absence. In the stock market, that sprained ankle represents idiosyncratic risk. By concentrating heavily into a handful of tech giants, you are taking on massive single stock and single sector risk. But you are absolutely not receiving the single stock premium in return. You are carrying the structural vulnerability of a highly concentrated portfolio while only getting the capped, blended upside of an index fund. It is a mathematically asymmetrical bet and not in your favor. Let us model a step-by-step mathematical vulnerability scenario using some highly realistic variables for the next few years. Assume you invest exactly $100,000 into the S&P 500 today. Immediately, $30,000 goes directly to those top 7 tech giants. The remaining $70,000 gets spread across the bottom 493 companies. Now, let us model a perfectly normal scenario for 2026, where elevated interest rates and persistent inflation drag cause a routine cyclical tech correction. Let us say those top 7 experience a 20% drawdown, which is a completely standard reversion to the mean for high beta tech stocks. Your top 7 allocation instantly loses $6,000. Here is the trap. To merely break even and see a flat 0% net return on your total portfolio, the entire remaining 493 companies must generate an 8.5% return in that exact same time period. If the broader economy is experiencing a mild recession and those bottom companies yield 0, your diversified portfolio drops by 6% based entirely on the idiosyncratic struggles of 7 tech CEOs. Beyond the sheer concentration math, you are also exposing yourself to massive valuation risk through price-to-earnings dispersion. Currently, the forward price-to-earnings ratio of the top 10 stocks in the S&P 500 hovers dangerously close to 28. Meanwhile, the remaining 490 stocks trade at a much more reasonable multiple of roughly 17. By blindly buying the standard index, you are mathematically forcing more of your capital into the absolute most expensive stocks on the market, effectively buying high and completely ignoring the value premium present in the rest of the index. Before we dive into the psychology of why smart people ignore this glaring math, I want to give you a clear framework to actually see these numbers in your own life. This is exactly why I built CashClass, the official Tom Talks Money web application. CashClass is the essential bridge between learning the math on YouTube and actually doing it. There are absolutely no invasive bank logins required. You just securely upload your CSV statements directly to the web platform. It even includes a free Budgeting 101 course to optimize your cash flow. Click the link at the very top of the description to start your 14-day free trial on the web. We will get to the exact quantitative core satellite portfolio allocation you need to fix this hidden leak in just a minute, but first, we have to address the behavioral trap. Why do incredibly smart people continue to make the wrong mathematical choice with their wealth? It ultimately comes down to recency bias and the extrapolation fallacy. The human brain is naturally wired to project the last 10 years of data cleanly into the next 30 years. Because US large-cap tech dominated the 2010s so thoroughly, everyday investors just assume this outperformance is a permanent, structural reality of the modern world. But they have conveniently forgotten the lost decade from 2000 to 2009. During that 10-year stretch, the S&P 500 yielded a negative nominal return for an entire decade. You made no money. Meanwhile, emerging markets and small-cap value stocks were quietly compounding by double digits. Ignoring market history is a luxury you cannot afford. The second major psychological trap is what I call the passive investing paradox, and it is built entirely on game theory. As retail and institutional money blindly flows into passive S&P 500 funds month after month, that money is algorithmically forced to buy shares of the largest companies. It mechanically drives their stock prices higher, completely regardless of their actual underlying corporate fundamentals. This dynamic creates massive, price-insensitive buying. The larger a tech company gets, the more passive funds are legally forced to buy it. This creates a reflexive bubble that works brilliantly to inflate your portfolio on the way up. But you have to understand that it causes violent structural fragility on the way down. When the macroeconomic flows eventually reverse, the selling pressure is just as algorithmic and price-insensitive as the buying was, pulling the entire index down with breathtaking speed. Then you have to factor in the immense gravitational pull of social proof. Deviating from the standard S&P 500 carries severe career risk for professional fund managers, and it carries intense social risk for retail investors like us. Let us be honest, it is psychologically much easier to lose money alongside everyone else than to underperform temporarily while attempting to be statistically rigorous. If the overall market drops 20% and your standard S&P fund drops 20%, you do not feel bad. You just casually blame the Federal Reserve or the global economy at neighborhood barbecues. But if you took the time to build a custom, risk-adjusted allocation, and you happen to underperform the broader market for one single year, you feel like an absolute fool. That powerful social friction is exactly what keeps millions of people tethered to a mathematically flawed index. The ultimate hidden penalty of ignoring all this is variance drain, which is also known in quantitative circles as volatility drag. Investors constantly ignore the harsh mathematical tax of volatility. The formula for your true compound annual growth rate is roughly your average return minus half of your variance. Because the cap-weighted S&P 500 is highly concentrated in high beta, notoriously volatile tech stocks, its overall variance is artificially elevated. A portfolio that experiences severe drawdowns requires exponentially higher returns just to recover its initial value. If you suffer a 50% loss, you do not need 50% to recover. You mathematically require a 100% gain just to get back to zero. Concentration drastically amplifies your portfolio's variance, and that variance directly drains your true compound net worth over the long run. This is exactly where conventional financial wisdom tells you to just hold on, close your eyes, and hope for the best. I am going to tell you the complete opposite. I want you to actively restructure. Here is the exact quantitative core satellite framework I use to optimize my wealth and hedge against this mess. We absolutely do not abandon the S&P 500. Instead, we deconstruct its vulnerabilities and we systematically hedge them. Step 1 of the protocol is to bifurcate your US core equity holding. To neutralize the dangerous momentum risk of the cap-weighted S&P 500, allocate a solid portion of your core to an equal-weight S&P 500 fund, utilizing a ticker like RSP. In an equal-weight fund, the mechanics change completely. Apple represents exactly 0.2% of the fund, and the absolute smallest utility company in the index also represents exactly 0.2%. Historically, the equal weight index actually outperforms the cap-weighted index over very long horizons. This happens because the equal weight structure legally forces regular, methodical rebalancing. It systematically forces you to trim your winners when they get too high, and buy the losers while they are heavily discounted. Think of it like a strict diet. Eating 500 calories is not a perfectly balanced diet if 150 of those calories come from pure, refined sugar, simply because the remaining calories come from 493 different microingredients. True dietary health, much like true financial health, requires properly balancing your macros. Moving capital into an equal weight structure naturally tilts your portfolio toward the size and value factors, giving you a much healthier, more resilient macroeconomic baseline. Step 2 of the protocol is factor-based hedging. You have to intellectually acknowledge that buying the S&P 500 today is essentially placing a massive, leveraged bet on large-cap growth. To achieve true mathematical diversification, you must own non-correlated risk premiums. I personally allocate 15 to 20% of my equity portfolio strictly to small-cap value funds, using vehicles like AVUV. Decades of rigorous academic research from economists like Farmer and French prove mathematically that small companies and value companies possess incredibly unique risk premiums that operate entirely distinct from large-cap growth stocks. When large tech inevitably stagnates or enters a cyclical bear market, small-cap value historically steps up and absorbs that massive capital flight. By holding both, you are finally capturing independent sources of return, rather than overlapping the exact same risk profile. Step 3 is geographic uncoupling, which is a pure valuation play. Right now, the United States represents roughly 25% of the total global GDP. But incredibly, it makes up over 60% of the entire global equity market capitalization. This is a severe historical anomaly, heavily driven by recent currency strength and massive tech dominance. The protocol here is to establish a strict 20 to 30% allocation to ex-US international equities, utilizing a broad fund like VXUS. This allocation immediately provides you with exposure to significantly lower price-to-earnings ratios and much higher dividend yields. Furthermore, it acts as a critical hedge against the idiosyncratic risk of a prolonged US dollar depreciation. If the dollar weakens structurally over the next decade, it will actively harm US domestic asset prices. But your uncoupled international holdings will mathematically appreciate, serving as a vital counterbalance. Step 4 is to establish strict mathematical rebalancing bands. Do not ever rebalance your portfolio simply by looking at the calendar. Rebalancing every January 1st just because the Earth completed a lap around the Sun is entirely arbitrary. Instead, you must rebalance by absolute tolerance bands. Here is the rule. If your target allocation for US large cap is 40%, set a strict 5% absolute band. If a massive tech bull market drives that allocation up to 45% of your total wealth, you automatically trim that 5% excess without hesitation. You then instantly deploy that harvested capital into your lagging asset classes, whether that happens to be international equities or small cap value. This mechanical framework strips the dangerous emotion out of the process. It mechanically enforces the ultimate, unbreakable law of successful investing. You are constantly forced to buy low and sell high. When I step back and look at the macro data, the warning signs are blaring. The Herfindahl-Hirschman Index, which is a standard quantitative measure of market concentration, is currently sitting at multi-decade highs for the US stock market. We are literally seeing concentration levels comparable only to the precarious peaks of the 1929 stock bubble and the 2000 dot-com bubble. That dangerously high concentration dictates that your future returns will be heavily reliant on the operational perfection of just a few massive firms. That mathematically elevates your sequence of returns risk, which is terrifying if you are nearing retirement age. Before we wrap this up, if you want to go deeper into these quantitative frameworks with me, hit the join button below to become one of the optimizers. Channel members get priority comment replies and custom sketch badges, and it is simply the best way to support the deep research that goes into these videos. Ultimately, we have to respect the gravity of mean reversion. Over rolling 20-year periods, the valuation multiples of global equities stubbornly revert to their historical means. Buying US equities today at a cyclically adjusted PE ratio of 34, when the long-term historical average is just 17, mathematically compresses your future expected yields. Diversifying by underlying weight, by academic factor, and by global geography is the absolute only mathematical defense you have against that brutal multiple compression. I want to hear your honest take on all this. Head down to the comments right now and let me know your current equity split. Do you personally tilt towards equal weight or small cap value, or are you happily riding the market cap tech wave? Consider it our peer review for the week. Stay rational with your capital, stick to the math, and I will see you in the next one.